So, interesting times for oil. The price, of course, riding very high because of those multi-decade low production levels and shale bottlenecks and plenty of interesting things going on and many questions about where the industry is going. So we've weeded out the wildcats for you tonight. We've got three sound and interesting companies, all doing slightly different things, involved in different parts of the production side, or indeed in different, I hate that word, geographies, but they're all operating in different parts of the world. So let's go straight to Paul Welch. He's the chief of SDX Energy, created in October 2015 by the merger of Sea Dragon Energy and Madison Petrogas. They explore and develop and produce oil and gas primarily in Egypt and Morocco. And indeed, Paul is having to jet out to Morocco this evening, so let's get on straight away, and you will forgive him if he has to whip out after his presentation. Paul.
Good evening, everyone. Thank you very much for having me. Thank you for that wonderful introduction. I'm Paul Welch. I'm the CEO of SDX Energy, and I will tell you a little bit about our company in the next 15 minutes. So, SDX is AIM and TSX listed. As you said, we were formed in 2015. Since we listed on AIM, which is in May of 2016, we've had seen a significant uptick in our share price. So it was a good deal for us. And I think the last thing we've done that people may have remembered is we acquired Circle Oil's assets from receivership in January 17. We primarily work onshore, so that keeps our costs low, so we can make money down to about $10 a barrel Brent. Our reserves are shown there, so reasonably good size. I think most importantly, we have a solid balance sheet, $25 million in cash and no debt. And we're generating probably $4 million a month in cash flow at current prices. We do have some financial flexibility as well because we just added a $10 million facility from the EBRD, which is currently undrawn. So we'll talk about what we picked that up for in a few minutes. We're producing, at the time we last reported our results, about 3,400 barrels a day. Subsequent to that, at the end of August, we were producing closer to 6,000. Our target is to produce just north of 8,000 barrels a day by the end of the year. So over the course of 2018, we're going to double our production. That means we're going to put on South Tassouk, which is a discovery up in the Nile Delta, which I'll talk about in a few minutes, at about 50 million cubic feet a day just prior to the end of the year. And we believe we're well placed to capitalize on acquisition opportunities in North Africa, which takes me to our next slide, which is our announcement that we put out on September 20th about a potential transaction that we're doing. Our shares were suspended at the time. There was enough truth in the leak that occurred that we had to suspend. And so unfortunately, this evening, I can't talk about that. And so if people can ask me all sorts of clever questions, and a lot of people are trying to trip me up and ask me some questions, I unfortunately cannot answer them. If the deal goes ahead, we will then file something with AIM, and our shares will be no longer suspended. And if the deal falls over, then we'll start trading again. The time frame for that is still uncertain, and when I have some more clarity, I will certainly tell everyone in the room what we intend to do. So please, I appreciate there's probably quite a bit of interest in that, but unfortunately tonight I really can't talk about it. So what I can talk about is our current business, which I think is quite exciting. Firstly, let's talk about Egypt. We have 4 assets in Egypt, 2 oil-producing assets in the Eastern Desert, Masada and Northwest Kemsa, an exciting gas discovery up in the Nile Delta called South Tassouk, and then we have a development opportunity out in the center of the Gulf of Suez called South Ramadan, where we're currently drilling a well. If we talk about the oil-producing assets first, starting with Northwest Kemsa, this is an asset that we've had since 2008 when it was an exploration prospect. Quite a successful asset. It's now essentially fully developed. We're producing just north of 5,000 barrels a day gross. We have 50% of this. As you can see, we are well above our targeted productions for 2018. Our work program is largely complete. And if we look at this field, it's very easy to develop. It's onshore, relatively shallow. We have 2 horizons under water flood, and our operating costs are very low. So we operate at less than $10 a barrel. And if you look at the net back there, at current prices, we're making about $20 a barrel Brent. So it's a great asset. Unfortunately, there's not a lot of growth here. So we essentially have about 3 to 4 years of production ahead of us. All the cash we generate from this asset, we then put back into other ones. So again, this is a great asset. It has been a great asset, but it's definitely seen its best years, and it's going to be declining going forward. So CapEx requirements here are minimal, just workover programs. So again, a real cash cow for us. If we then talk about Masada, our other oil field in the Eastern Desert, this is a slightly different story here. This field is shown there, I don't know if there's a pointer in this, but it's shown here. It's in and amongst a number of fields operated by another producer in the Eastern Desert called TransGlobe. We share a little bit of the field with TransGlobe, but this field has a lot of growth. So it was originally discovered in 2011, and then in October 2017 we made a second discovery. So if you look on the production figure here, you can see that production growth has been pretty substantial, and there's still more to go. Our work program is largely complete there, and you can see our target production, we're above that, and I think at the moment we're probably another 1,000 barrels a day above that target at the moment. So we've had a lot of good success here. If you look at the next slide, again, another low-cost operation for us, again, onshore. This produces a relatively heavy blend of crude, so we get a Brent price less, about a 30% discount. But if you look at the netback, you can see here, this is a different contract. So this is a service agreement, so the fiscal terms are better. So you can see at $75 Brent, we're making $39 in netback. So this is a real cash generator for us. And like I said, we've had some recent success. And what we're showing here is a map of our Rabble discovery, which is on this slide. It's just up to the north. It's just sitting up in here, and on the great side in this part of the concession, where we made a discovery in October. We've drilled 4 successful wells with 1 more to go. These wells are drilled to about 4,500 feet. They have anywhere between 100 and 200 feet of pay, and so they come on at between 500 and 2,500 barrels a day. We still see some growth in this asset, and so moving into 2019, we think we're going to have another couple wells here. So again, more growth to come. There are other fault blocks that have yet to be tested. So as we move forward into 2019, we see some more potential in this field that we intend to develop. Okay, if we change gears now, we move up to the northern part of Egypt and we talk about South Dusuk. This is an asset that we picked up in 2013. It's an exploration asset. It's at the southern extension of a series of fields that start in the offshore and come to the onshore. Our thoughts were this trend would come into the block and essentially then truncate. So we picked up the block, we agreed to drill 1 well and shoot 300 square kilometers of 3D. We did that, and thankfully our first well was successful, and now we followed it up with 3 additional successful wells. The last success we had was the Ibn Yunus discovery, which we'll talk about here on the next slide. So if you look at the South Dusuk field itself, what we're showing here for those that are geologically inclined is a well section. We have essentially 3 zones of pay, which are shown here in the cross section. This is the field aerially. I think the most important part of the slide is the test rates here. These wells are very good quality sandstones. All these rates are essentially surface constrained. So, you know, between the 3 wells, the test rates are in excess of 80 million a day. On plateau, we're building a facility that can handle 60, so we can clearly fill that up. And then if we look just 4 kilometers to the north, we made another discovery called the Ibn Yunus field. It's in a shallower section and called the Kafr Sheikh. The pay section is again here. And on test, this well flowed in excess of 40 million cubic feet a day. So, you know, this is a wonderful place to explore. We are 4 for 5, so we've drilled 5 wells out here and 4 have worked, 1 hasn't. So that's a pretty good success rate. And when we look across the rest of the acreage where we already have 3D, we see about 2 TCF of gas sitting in the Abu Madi, which is where we've had the most success. And then we have another 300 to 400 BCF that we're in the process of identifying up in the shallower section of the Kafr Sheikh. And so what we're showing in this slide here is a look at the prospectivity that we've currently mapped in the Kafr Sheikh. And for those of you that are kind of footy inclined, the names of those prospects are the names of the football players for the Egyptian World Cup team. So as you can see, Salah is the biggest and best one we have, and that's probably appropriate. So as we move forward into 2019, we're going to probably drill 3 additional wells into this to add to our inventory of success and fill up that facility even more. So as we continue to have success in this, we're going to bulk up that facility. So at the moment, we're constrained to about 60 million a day, but we can add chunks of 30 million a day in processing. So as we continue to have success, we're going to add to the portfolio here. So we're quite excited about the potential up in this area. And to build on that potential, what we're showing here is a work program that we're starting at the moment. So we've shot 300 square kilometers of 3D up in the north. We're now acquiring another 170 square kilometers to the south. The outline that we're showing, this dashed line, is this channelized system where we see, in excess of 1,000 feet of good quality sandstone. And so our objective is to find these things in closure. So by the end of the first quarter, we'll have this acquired, processed, interpreted, and then we're going to drill 6 additional wells in 2019, 3 up in the north and 3 to the south. And one of those wells in the north is going to be targeting an oil prospect called Young. And so for those in the room, which I recognize a few people that ask me this question every time we meet, we're going to drill it next year. It'll be in the second half of the year, and we're looking forward to it. So it's the Young prospect. It's a deeper Cretaceous oil play, and we are going to drill that next year. So that's it for Egypt. I think we have a great business there. Potentially it's going to expand, but that remains to be seen. Now let's talk a little bit about Morocco, where we think we have another fantastic business. So in Morocco, these are assets we picked up with the Circle acquisition. So with Circle, we picked up Lal in the north and south, and then the Sable permit, and then subsequently we added the central permit here called Rarb Center. We have a 55-kilometer pipeline that takes our gas from the wellhead into the city of Kenitra, where we sell it to industrial customers. And then what we're showing here is the outline of a new 3D survey that we've just acquired and finished only recently. So if we think about Morocco, and Malcy was down on a visit that we had down there, and the way we describe this is simplicity made profitable. This is a great business. The wells are shallow. We produce gas that is called biogenic. It's 99.6% methane. It doesn't need to be treated. And so we take it from the wellhead straight into our customer. We sell this gas for about $10 an MCF to our customers. And our net back on that is about $9.20. So that's, again, a fantastic business. At the moment, we're selling about 6 million cubic feet a day. The pipeline has the capacity to handle 24. We've identified demand of 52 in the city that we sell into. And so we've initiated this project Encatra, Project 24, with the state to fill up this line over the next 3 years to essentially maximize our revenue through this line. When we look at the potential to grow up to that, we have identified 50 BCF of gas potential in the areas where we currently have 3D. It doesn't include the recent 3D. And to fill up the pipeline for 24 million cubic feet a day, we need 45 BCF of reserves. And so we think we've identified those. And like I said, we're adding to that inventory with the recent seismic. We just completed a 9-well program where 7 worked. And in the second half of 2019, we're looking to start another 12-well program. So a lot happening here. Again, this is more of a kind of a summary of where we are. The gas here is sold at quite a high price given the previous price environment. So we sell it at between $10 and $12 an MCF. The reason for that is that there is very little alternative, a few alternatives to our gas. The real alternative is essentially compressed natural gas, propane, that's selling at $18 an MCF. So at $10, we're still undercutting that by quite a margin. We're entering into some new contracts, so we've just signed up 3 new customers, and we'll be announcing the prices in those contracts relatively soon. The biggest one is Peugeot. The car manufacturer has just put a plant just outside the city of Kenitra, and we've started to sell gas into that plant on a test basis. And so that is going to kick off a lot more of development in the area and a lot more sales of our gas. So a lot to look forward to here. The last thing I'll talk about in brief is opportunities we see, what we describe as a roll-up opportunity. So in Egypt, there's a large number of players. They range in size from E&I, who has a Zohr discovery, down to people our size. And so, what we found is that there are a lot of companies, in our view, that are kind of too small to survive. And so our idea is to kind of roll those up together through a series of acquisitions, similar to what we've done with Circle and prior to that with Madison Petrogas, and to create a much larger and much more stable company. Again, we've done 2 transactions so far. Potentially we have another one in the works. So, you know, we think this is a model that still has legs even in this current price environment. In a low priced environment, it was fantastic because we were one of the few people that was working in Egypt, but in this higher price environment, we still think it works. So we're targeting those companies that are shown here in that bottom circle, where they're primarily oil producers, relatively small, but have very good businesses because they're primarily onshore. So putting those together, creating a larger company is the objective of SDX. And so you're going to see us, you know, add our reserves through the drill bit and also through some M&A activity. So stay tuned. So to sum up in brief, this is the work program that we've had for 2018. We currently have 1 rig running still, and that's drilling our South Ramadan well, which is a commitment well, and that well should TD hopefully in another 30 days. After that, the last thing for 2018 is we're gonna start acquiring seismic in South Asuk, and then we're gonna start gearing up for rig programs in 2019. And we're gonna have a 6-well program in South Asuk and at least a 12-well program in Morocco. Gemsa and Maseda, we think, are probably not going to have much happening until the latter half of 2019 with Maseda, but probably nothing in Northwest Gemsa. Valuations are shown here. Myself and I'm sure my other 2 colleagues at the table in the front of the room here are going to tell you that we're very undervalued. I think we're more undervalued than them, but they will certainly express their view on that. But we think there's a lot of value in the stock. Unfortunately, our stock is suspended due to the leak, so you can't unfortunately buy any tomorrow. But we think there's a tremendous amount of value in the stock, both in Morocco and in South Asuk. So we think it's a great opportunity for everybody. So to conclude, you know, we think we have a strong business at the moment. We've been very successful with the drill bit. We're very well funded. We have, you know, a lot of cash. We're generating cash. We have a credit facility that's undrawn. I didn't talk about the credit facility, but the reason we put that in place is to essentially invest in infrastructure in Morocco to connect additional customers to our pipeline. That kind of capital is capital better from institutions that are looking for smaller returns rather than our risky capital. So we entered into that facility. Looking ahead, you know, we see a lot of growth in the portfolio, and like I said, our intention is to exit 2018 at twice the rate we entered, and we think we're on track to do that. And with that, I'll open it up for any questions.
Okay, so questions then for Paul. He's got a few minutes before he has to go. While we're getting the microphone to you, have we got it ready? Yes. Let me just ask, we've got, of course, the legend that is Malcy Graham-Wood with us throughout the evening this evening. Obviously, considers and writes about all these companies. Since the issue of valuation was raised, obviously, there are different reasons why companies go on and off your bucket list and have your attention. Could you just say something about valuation? Because obviously that's the reason people look for these shares, because they hope that it's going to be worth a lot more in the very near future.
Well, that's what I'm going to talk about later on. No, I mean, the point is, you know, that the valuations of all the companies here tonight are amongst those who I consider to be most attractive in terms of the discount to the valuation that could come through. And I think that the way that I'm sure these that Fiona and Andrew are going to add to what has already been said is that the value of what has already been discovered in the ground is still significantly more than is in the share price at the moment, and on a low rate. I mean, you can talk about, you know, $5 in the ground or whatever, but the point is that, you know, these are all companies which have assets which have been discovered and a significant upside on the exploration side. So I think these are 3 perfect examples of extraordinarily cheap stocks.
Great. Okay, well, more from Malcy later. Questions then for Paul. One over here.
You mentioned merger and acquisitions, but have you looked into the recent Egypt bid round at all, and particularly to the north of your South Asuk block?
All right, there's two bid rounds ongoing. There's an e-gas bid round, and which is one you're referring to, and there's an EGPC bid round. So we participated and intend to participate in both those. Again, the e-gas bid round doesn't close until the end of November, so at that point in time, we'll make a decision as to whether we submit a bid or not. But both had interesting acreage, and both I think are going to attract a lot of interest from the industry, so of which we'll be one. So we definitely are participating in both. That doesn't mean we're going to bid, but we're definitely participating. So.
More questions? One over here.
I thought I answered your question already.
Good evening, Paul. Yeah, no, I'm not going to ask you about the oil play. Could you just give us an update on where you stand with the gas negotiations in South Dasuk and an element of, or an interest in price?
Yes, so I think we're largely finished with those discussions. You know, again, until we have to put out announcements exactly what they are. There's a minimum price that is paid, and we're not going to get much higher than that price. We negotiated for a good 6-9 months on it. I think we were tossed out of the minister's office 2 or 3 times, so he knows who we are. Yeah, it's with the discoveries that they've had and the success in the Med. To make a pitch for a higher price onshore is a pretty challenging thing. So I wouldn't expect much more than the minimum, the statutory minimum price. And for those who don't know what it is, it's $265 an MCF. So we're going to be thereabouts, I would expect.
Thanks.
Sure.
Can you just say something about political risk in Egypt and indeed Morocco?
Okay, I think Morocco's easy. Morocco's fairly stable, and I don't see much political risk in Morocco at all. It's very stable. It's been stable for quite some time. I think in the case of Egypt, the political risk has significantly decreased. So President Sisi has been in power since 2013, and the economy has really improved. The IMF has put a package of support in place for Egypt that has done wonders. They floated their currency, and so you don't have a dollar short of dollars any longer. So it's decreasing all the time in my view. People are being put back to work. They reduce the subsidies. The economy is healthy. So as we move forward, it seems to get better. It's not perfect. No place is. I'm American, and we can talk about that for a long time, but so no place is perfect. But I think in the case of Egypt, we are much less concerned about the political risk in Egypt now than we would have been, say, a year or 2 years ago. So we think it's a very positive environment, and we think that the interaction between the existing authority and the IMF has been very positive for the economy and for most Egyptians. So we're very comfortable there.
Final question, because I know you've got to run away.
Sure.
Over here.
You mentioned that Peugeot were buying the gas on a test basis.
Yes.
So when would we have clarity as to whether they want to become permanent customers?
Well, I think they're going to become permanent customers. It's just until they take gas on a continuous basis, then we can sign the contract. Then we'll move forward and we'll announce that to everyone. So there's no doubt that they're going to take gas for the long term. The amount of gas they're going to take isn't huge, because the gas that they're taking is used for a certain part of their facility, which is, it's not that exciting, but it's where they generate heat to dry paint on new cars. And so that's what they're going to use it for, very industrial use. And as that facility increases its production rate, the volumes will go up. The volumes aren't enormous. They're between 500,000 and 2 million cubic feet a day. It's not huge, but it will increase over time when they go from 1, 2 to 3 shifts of cars. And so at the moment they're like half of a shift. So they work 4 hours a day, not every day. And they manufacture a car, they test it, they send it back to France, they inspect it, and then they're kind of kitting out the plant as they move forward. Our expectations is that by the second quarter of 2019, they'll have a continuous run, and that's when we'll start selling gas on a more regular basis there.
And you're expecting to extend the pipeline into Lanamuna?
That's already done. The pipeline is complete. We've connected the facility, and so we are selling gas on a select basis, not every day of the week, but we are providing molecules of gas to them as we speak.
Okay, well, Paul, thank you very much indeed for finding time. Obviously, a very busy schedule today. We look forward to your shares coming back to trading, and maybe an interesting announcement in the next few weeks.
All right, thank you
Paul,
very much.
thanks very much indeed. Take the mic off, if you will. Excellent. Fine, okay, well, let us move on to our second guest this evening, Andrew Knott, the chief of Savannah Petroleum. Now, this company is especially focused, I think it's fair to say, because of their work with maiden production sharing contracts in southeast Niger. So a different part of the world. They've just confirmed yet another discovery. I think we're going to be hearing all about that. And Andrew has a different kind of experience. Obviously, our last speaker was a geologist. This guy was a fund manager. He's got a string of famous name companies behind him, notably Man Group, GLG Partners, but now he's firmly in the helm at Savannah. So let's hear from him now.
Thank you very much. Can everyone hear all right? Is the mic okay? Okay, guys. Well, look, thank you very much for having me to speak. For those that aren't aware, Savannah Petroleum has been listed now since 2014. We're listed on the AIM market, London Stock Exchange. We're focused around two countries, Niger and Nigeria. To cut to the chase, in terms of the business in Niger, is exploration focused. We're in a basin which is a very large opportunity. The historic finding cost in the basin is about $1 a barrel. The NPV is about $6 a barrel, and therefore, and you've got a basin which has a 75% exploration success rate. So that's a good capital appreciation business model. And most importantly is it's very straightforward, the monetization path. So from turning a discovery into cash flow, which we'll talk about in a sec. In Nigeria, we're in the process of acquiring a series of two large oil and gas fields. Both are about 500 billion cubic feet in size, with about 10% associated liquids, and a very interesting infrastructure business, which is the only business of its type in that part of the country, with a lot of growth. So we'll talk through each business in one by one. I'm not proposing to go through every single slide that we have here. I'm really proposing just to hit the highlights and then open it up to Q&A. So in Niger, Niger is the country on the top left in the initial map. You can see a blow up of the basin that we're in, which is called the Agadem Rift Basin here. The first thing to say is it's part of a very prolific system called the Central African Rift System, which are these green blobs on the maps. It's a series of Cretaceous and Tertiary rifts. In aggregate, there's over 6 billion barrels being discovered in that system, but most importantly, everywhere there's been oil discovered in that system, full stop, is currently in production today. So it's an area where discoveries have been monetized relatively quickly. When we go into the basin that we're in, the Agadem Rift Basin, the first thing is to talk about is the scale. It's about 30,000 square kilometres. That's about 1.5 times the size of Wales. We have 50% of that basin under license through two separate production sharing contracts. One's called R1, R2, which is this area here, and then R3 and R4. The balance of discoveries are held by CNPC, which is the largest oil company in the world, and they've been very successful. On the left-hand side, we talk through what's happened in the basin in the recent eras. The bottom line is there's been 129 exploration wells drilled by CNPC. They made 95 discoveries, so a 3 and 4 success rate. They proved up 1 billion barrels. They've acquired literally telephone number amounts of seismic data, 13,000 line kilometres of 2D, 13,000 square kilometres of 3D. They've drilled over 250 wells, delivered first oil within 3 years of entering the country, and that says all you really need to know about how to do business in country. They came in from a standing start in 2008. By 2011, they built a refinery and a pipeline and delivered first oil for the country. They went through what's called a relinquishment process. Then in 2 tranches, Savannah picked up first of all the R1, R2 PSC area, then the R3, R4 PSC area. A project like this, which is very large, there's a lot of data. The first thing you have to do is consolidate that data and make sure you have a good corporate understanding of it. We went through that process. It took a couple of years. To the point where we started our exploration activity in this area here at the beginning of the year. We've drilled 5 wells. They've each proven to be successful, and we can talk about them in a second. The reason why we chose here within the permit areas was really the quality of the data that we had, the proximity to the existing and the proximity to the existing large producing fields directly on trend, and also where the main infrastructure and logistics bases are in the basin. I think just to understand why we like the project or why we're attracted to it, it doesn't matter what oil and gas project you're showing. For an oil and gas field to exist, 3 or 4 things have to have happened. The first thing, the oil's got to have been made. In this basin, every single well that's ever been drilled has encountered hydrocarbons. The reason for that is you've got 2 very prolific source rocks which underlie the basin. Secondly, you need a reservoir rock, so think of like a hard sponge with holes in it, so if the oil gets in it, it can hold it in place. Again, every single well that's been drilled in the basin has found good quality reservoir rock. So those 2 main risks are not thought to be particularly material when we look at exploring in the basin. Where the main risk is, and where you can have a situation where you don't end up with a commercial oil field, is because you have a trapping issue. So the oil gets made, it migrates, it goes into a reservoir, and you need something to stop it moving any further. The way we mitigate that, or the way that we think it's relatively low risk as well, is firstly, in the main play that we target, there's 5 or 6 reservoirs to target, which are largely independent of each other, which means you get a lot of shot at the dice. Secondly, to mitigate the risk, it's all about getting good quality seismic data. For those that are technically inclined, I'm not going to go into detail, there's a cube which sort of shows how the main play type's set up, but the main takeaway is, every time we drill, we don't know which of those 5 or 6 reservoirs is going to come in, to be brutally honest. But you know that statistically it's highly likely that at least one of the 5 or 6 will. Of the 100 plus discoveries that have been made in the basin, no single well has ever had oil in all 5 or 6. But your average discovery has oil in 1 or 2, and that's what we're looking for. There's a whole lot of other stuff about prospectivity, seismic lines, etc., but I realise that in the interest of time, it's better to be concise. So I think just on Niger, I think the key things to take away are, when we first came, there were 4 issues with the project. The first is, can you finance it? Well, we've managed to do that. The second is, can you actually operate in country? The next slide shows that actually it's pretty straightforward to operate in country. Everything we've done has come in ahead of budget, as you can see, whether it's drilling wells, acquiring FTG, or acquiring seismic. There's 2 real reasons for that. The first is, I think we've got good people, and we've been able to attract good people. The second is, we're not trying to be clever, we're not trying to reinvent the wheel. We're simply taking what the guy next door is doing. We're making small amends, but not big amends, and copying them. All the infrastructure and logistics networks are established in country. You've got the world's largest land drilling company in country. You've got the world's largest land seismic company in country, and they've acquired a lot of data, and that's what we're using, and that's how we're trying to progress the project. So from an operating environment perspective, so far it's been pretty straightforward. The second issue is, fine if you can operate there, but is there actually any oil? Well, I think what we've actually discovered is a really good way to talk through how we view the prospectivity. So the first thing is, we're in a rift basin. If you go to a super extreme example like the central North Sea, you've got 64 proven play types. In Agadir, you've basically got 6 play types, of which, actually it's outlined here. But of those play types, nearly all of those discoveries, of the 109 discoveries in country, 103 sit in that play I talked about before. You find that then had some shallower, some deeper, but there's not been a lot of money spent on that. So when we're talking today, we're going to talk about just that main play type. But in the real world, that's nothing like what we've got to play with here. There's going to be a lot more discoveries. People are going to be making discoveries in new play types in 20 years' time. But even on that main play, when we inherited the R3 East area, on the existing data set, you could see Kunama and you could see Bushaya pretty easily, and you would probably have been confident enough to drill it. We then acquired, so those are discoveries that I think CNPC could easily have drilled, but for whatever reason they probably didn't have enough time. The AMD discovery, which is a very large discovery for the basin and the best discovery that we've made, you really need 3D because it's a long and skinny structure, and I'm not sure we would have had the confidence to drill it without 3D seismic. Zomo is similar because Zomo is very similar to AMD, so if AMD hadn't worked, you wouldn't have drilled Zomo. But then as well, just by taking a different technical view. So the Eridal discovery, which was our 4th discovery, was actually the structure was drilled by the previous operator. They abandoned it as unsuccessful. We drilled in a different location and it came in as the 2nd largest discovery we've made. So the point is, even on that one play type, there was stuff that was left behind that the previous operator could see. There was stuff they couldn't really see, they needed 3D seismic for, so additional data helped out. And there was stuff that if you just take a different technical view and you back the people that are doing their subsurface work that can come in. And that is something, a story which I expect is highly replicatable across the license area. And then the last and most important thing is you can discover as much oil as you want, but if you never get out of the ground, it isn't worth anything. So from a monetization perspective, that's something which we've similarly, alongside the drilling, we've made a lot of progress on this year. So we signed a deal with the Ministry of Petroleum of Niger, whereby we'll get into the refinery and we'll be able to sell probably up to 5,000 barrels a day, possibly slightly more, but if we assume 5,000 barrels a day directly into the refinery. The capex to first oil is less than $5 million. As we ramp up, we'll probably put in a pipeline. We intend to work with an infrastructure fund to enable that. But the bottom line is, compared to how we were previously looking at first oil, which is a big long trucking solution to Nigeria, to be able to get directly into the existing infrastructure has been a major upside surprise for us this year. The second thing is, you've had the pre-feasibility study completed on the export pipeline to Benin. You've had tremendous progress made on the spur line from that pipeline, which is intended to go into northern Nigeria. And most importantly, Savannah's been put on the technical committee, so we're involved in the discussions around that. So we're looking at basically early production next year, followed by export oil in 2021. We can still truck incremental barrels into Nigeria as well, but that's not the main focus just now. The main focus just now is delivering into the refinery, and it's very remunerative. So that's Niger. So high success rate, low finding costs, clear path flow to monetization. We've got 120 structures we've identified for high grading for future drilling campaigns. We expect to start drilling again in Q1. Okay, in Nigeria, just very quickly, we're in the process of acquiring interest, as I said before, in 2 large oil and gas fields. One's called Uko, one's called Stub Creek. Uko is the cash engine of the existing business. It's in production for gas and liquids. Stub Creek's in production for liquids only, not gas. Essentially what happens is they're selling into very long dated contracts. The first part of the contracts are satisfied by Uko, and then Stub Creek is developed and will satisfy, it is intended to satisfy the back end of the contracts. Nearly 25,500 barrels a day of take or pay volumes. 99 million barrels of 2P, 62 million barrels is 2C. Most of that 2C is just the undeveloped Stub Creek gas, so geologically it's the same. It's just we haven't sanctioned that, but we have got clear contracts for it. 92% of the contracts that we have are now to investment grade credits, which is a major value arbitrage that we achieved as part of the ongoing acquisition process. We expect the acquisition itself to complete in this quarter. And really, I think the emphasis now has moved away from buying an undervalued cash flow set to really looking at the growth potential in the business, which wasn't really the focus when we did the original acquisition. So I think the first thing to say is that this infrastructure is the only infrastructure of its type in that part of Nigeria. The major competing source of power is diesel. Diesel's priced at $15 an MCF equivalent. We currently sell gas to customers at $3.50, so there's quite some improvement that we can offer by selling gas to industrial customers for power. On top of that, you have a massive uptick in terms of reliability. Diesel is imported in Nigeria. It is not a reliable source of power, so there's compelling both economic and practical operational reasons for why customers should be shifting. The way that works is at a $7.50, for example, price, which is where the company's been negotiating agreements. That would more than double our margin and realization. So what I'm trying to say is that we see a clear market for growth, and that those incremental contracts will be priced at a much higher, are expected to be priced at a much higher price than that which we're selling to when it goes to industrial customers. The other issue is from a power industry's perspective as well. I'd be quite hopeful that if we look at some of the customers the company used to supply but doesn't supply today, there's the potential to start to resupply them, which again would enable us to deliver quite a significant uptick in volumes. So aligned to that, there's 40 trillion cubic feet of undeveloped gas within tie-in range of the infrastructure, and the infrastructure's got significant spare capacity. So it's not just about increasing the margin on our existing gas resource, it's highly likely that we should be able to add additional resource over the process of time. There's a slide on the NPVs and all the rest of it, but I'm not really going to labour the point. I'll echo what Paul said and say everybody's cheap. I think that the key thing, or the key message about why we're specifically interesting, is you have two businesses with that are material. So the Nigerian business is 10% of the country's power supply. The Niger business is half of the main petroleum basin. And I think we've de-risked them, and they're to a point now where they've got clear that it's pretty straightforward to value what's there already. And then in the Niger business, through exploration, there should be a lot of repeatable and replicable success that we can deliver and get it into cash flows. And then on the Nigerian side of the business, you have the stable base, which over time we should be able to bolt on and add things because we have this very unique infrastructure position in country. And with that, I guess we'd open up to questions.
Thank you very much. So, questions then for Andrew. While we're thinking about that, can I just ask you, you set this company up as somebody obviously whose job it was to assess other oil players. Was there anything particular about, because I mean it seems fairly complicated here, you're sharing contracts and so on. What was the aim? Obviously you talk about monetising all these assets as quickly and efficiently as possible. What were you trying to do differently from other oil players?
Well, I don't think it's about necessarily doing things differently. The oil industry is one of the largest industries in the world. A couple of years ago it was 33% of global capex, so there's a room for a lot of people. But I think that, so in terms of the motivation for the founders of the business, so me personally, I was at a very entrepreneurial place. We sold that business, so GOG was sold to Man Group. There was quite significant cultural changes, deals ended, etc., and the decision was maybe wanting to do something a little bit more longer term orientated and could see many opportunities. And so at the time when we were setting up Savannah, we looked at several ideas, several opportunities, and then the one we came at was the Central African Rift System. For those that remember, there was a very successful company at the time called Caracal, previously called Griffiths. They did essentially what we did in Niger and Chad, whereby they did a deal with to acquire relinquished assets of Exxon rather than we did it from CNPC. And then they did a couple of deals and they ultimately sold themselves for a couple of billion. And so that looked like a good business model for us, and then that motivated Niger, and then the opportunity for Nigeria came in over time. So I would describe the outlook of the management team and the board as long-term greedy, not short-term greedy, but definitely looking to add value, and everything has a price.
Okay.
Evening, Andrew.
Hi.
Not my usual jumping off point question. A different question. You did an excellent swap deal recently, and you say the 70 deal is going to be signed off this last quarter. You've mentioned previously there's lots of other deals in Nigeria. Do you actually have some sort of vision about, once the deal's been done and the money's assured, the cash flow's assured, have you got things on the go that are ready to go relatively quickly without giving too much away, obviously?
So I think the focus in the business just now, to be absolutely clear, is around the two large assets that we have and optimizing those assets. Okay. So we could sell things, we could buy things in the case of both assets. In terms of Nigeria specifically, I think you've got to look at the opportunity set that sits around. If you have gas in that part of Nigeria, the obvious discussion to have is with Savannah, because otherwise you're going to have to replicate the infrastructure, and it's quite a prohibitive cost. It was $1 billion to put it in, so it's sort of unlikely that someone's going to voluntarily put that in when there's spare capacity sitting there. And a lot of the times the owners of that resource, in the case of a major, they may be paying a flare penalty, so it's a liability. In the case of an independent company, they were almost certainly exploring for oil, they completed the well and it tested gas. So you're not looking at something which in the vendor's hands to them today is particularly worth much, but through a deal to monetize it, clearly it can become worth quite a significant amount. So I wouldn't expect us to be going and spending, I don't expect any significant upfront consideration. I would say resource addition deals in this part of the world are likely to be more on a profit share basis going forward. And the good thing is as well, a lot of the gas, especially as you go further north, is pretty dry, so the separation facilities you need are pretty simple, so you don't even necessarily have to use CPF capacity up. You can just spur them with very basic separation directly into the main pipeline. So the answer is we're working on stuff all the time, but don't expect us to do something which is not. I expect the next series of deals that we do will be very closely related to the existing assets that we have.
You certainly appear to be woefully underpriced at the moment. Hello, you can hear me, can you?
Yeah.
What do you see as a catalyst, the signing off of the 7E deal? What's going to move the price?
Okay, so I mean we've had quite a good run over the course of the last couple of months, but clearly I would completely echo your sentiment. So, and one thing about Savannah is the board and management team have put in just under $7 million of their own money, so it's not like we're not personally invested. So, like in terms of the main catalyst, so implementation agreement this month, followed by deal completion this quarter, the recommencement of drilling in Niger, which will be next quarter, first oil in Niger, which is sort of a continuation of the well test, which is expected to start in December. There will be, as you've hinted at, additional activity on the deal front, but I don't want to front run that, but there will clearly be additional things that we can do to optimize things. And I think really the ultimate catalyst is cash flow, right? I mean, you start delivering the cash flows that we anticipate to deliver from the business, it becomes very difficult to ignore that.
Is it the case that a certain market cap size will bring institutions in?
Pardon?
Is it the case that a certain market cap size of market cap will bring institutions in?
Well, look, I think, just now we were about 88% institutional in terms of the shareholder register, so we're already in a pretty good shape there, and we've got very long-term orientated shareholders that we've known for a long time typically and fully understand what the business plan and the business model is. But no, I think what we need to do is you deliver on the cash flows, you deliver on the drilling campaign, and everything else will look after itself. I'm not somebody that sits looking at the share price on a daily basis. That's not the psychology.
No, I don't think we do now either. A dividend next year?
Yes.
Okay.
Yeah.
Thank you very much.
No problem.
Question at the front here.
How is the downstream taxed in Nigeria? The downstream gas?
You mean at the power station, or you mean at the
ACU gas level?
Okay, so in very simple terms, there are we don't anticipate to pay significant tax in that business for a long time, given the tax losses that exist from the previous from basically the previous investment and issues that that's had. So
This is Seven Energy. the previous one.
yeah, so the midstream business was a very significant investment which had its challenges, which is how we were able to buy it, which means that from a taxation perspective in the near
They
term.
had trouble servicing their debts, essentially.
Yeah, so
Would
Seven
that ever be an issue for you if it takes a lot longer?
So we did quite a few changes. So when Seven Energy had $1 billion of debt, Savannah will have $85 million of debt coming out of the transaction, none of which is going to be recourse to Savannah Petroleum PLC. There will be additional debt which is segregated into the midstream, for which Savannah is a minority partner, and we partnered with the private equity firm which has made a significant investment, which is agreed to make a significant investment in that business. So the other thing is that the big issue is payment assurance. So when Savannah first looked at the business, she had 20% of its sales were to investment grade credits. but through a guarantee scheme that we did with JP Morgan and the World Bank, that moved to 92%.
So it's a much smarter setup.
We got rid of a lot of the debt, we restructured a lot of the debt, termed it out, and most importantly we dealt with the fundamental issue, which is around control of the business through the transactions you mentioned, and also through credit enhancement.
Okay, so any more questions for Andrew Knott? Good, well thank you very much indeed for sharing your thoughts. Well, now I feel we ought to have some Bolivian flute music or something, but we haven't laid that on because we turn now to a different country altogether, Central and South America. And Fiona MacAulay is Chief of Echo Energy. I was talking to one or two people earlier who are definitely your shareholders, so they'll be very interested in hearing from somebody who has, I think, I dare say, 30 years of experience in the oil and gas industry. Certainly never a veteran, but certainly a legend. Over to you.
So Echo Energy was launched in the spring of last year, so a little over a year ago, almost 18 months now. And its mandate was to build and grow a business in Latin America, South and Central America. And the rationale for that was to really take advantage of a lot of the infrastructure that existed across that continent that is currently underutilised. It sits running at less than capacity. And actually in our business, one of the most costly parts of the business, as Andrew mentioned earlier, is it's no point producing oil and gas if you can't actually get it to market. So having the ability to utilise that infrastructure really brings down the costs for a company such as ourselves. We are the newest kid on the block of the three companies that are presenting here, and currently the smallest, but that we hope will not be the case in the next 3 years. So our asset base sits in Bolivia and in Argentina at the moment. We have a series of licenses down in the southern part of Argentina in the Austral Basin, which sits right down here on the southern tip of Argentina. That's actually the oldest hydrocarbon producing province in the country. And that is connected directly, just so that we're aware, up to Buenos Aires and goes through a number of other conglomerates en route that take a lot of the gas that is produced from that basin. Just recently, and perhaps we can talk about macroeconomics in general in a moment, but just recently there has been the sanctioning of the ability to actually export gas from that Austral Basin over to Chile. So we now have another export route in addition to feeding into the domestic and industrial markets in Argentina. In terms of oil exports, we're exceedingly lucky because within our operating acreage, we do have access to a direct oil export terminal. So we're little more than 40 kilometres away from actually being able to take oil that we produce in the field area into the export market. So we are, as I say, listed on the AIM market. We are a full cycle exploration-led, I would say gas-focused, but we are increasingly increasing our oil production, E&P. Our production at the moment sits at around about 1,000 BOE a day. About a third of that sits in oil production, and that's something that we're building. And the other remaining 2/3 are in gas production, and that gas production is sold into a series of consumers across the country. We have no problems at all in selling all the gas that we produce, and we also have no problem at all in selling the oil. That's all sold in dollars. Not only dollar denominated, but actual dollars that come straight back into our accounts. I would like to just mention a little bit on the macro environment in Argentina. I mean, we've all seen the news over the last number of months. There is rampant inflation. We have seen a severe devaluation in the peso. When we entered into these assets, the exchange rate peso to dollar was about 18 or 19, and we're up above 40 at the moment. So are we worried about that? Inflation is never a great thing. We're worried about investor sentiment, but for us personally and in our asset base, actually, if anything, it's been a bit of a positive benefit to us. We maintain a strict treasury policy where, as I say, all of our cash is kept in dollars, we pay all of our bills in pesos, and we convert those dollars on the day. So in real terms, across our contracts, we've seen over the course of the last year probably a sort of benefit of in excess of 25% in terms of our operating costs. Historical data indicates that actually inflation takes around about 3 years to catch up with the devaluation. So in a real sense, we are actually, sadly for Argentina, but happily for us, we're actually benefiting from that situation. In our interims, which were published to the end of June date, we had cash on hand of $34 million. And that leaves us as a pretty well capitalised company in this region. Just to focus back on what the last year has brought to us, we completed a transaction in Argentina to get into 3 main asset bases. They're not quite as well named as footballers in Egypt, and they're rather more boringly known as Fraction D, Fraction C, and a little bit more punchy Tapiaiki. So that deal completed in January. We're now in the middle of October. Since completing that transaction, we really hit the ground running. We are the technical operator on 2 of those block sets, Fraction D and Fraction C. And what does that mean? Well, that means that fundamentally we sit there as some of the brain power behind actually completing these operations. So our team, which we've been building significantly in the UK, is responsible for some of that brain power in determining where to drill the wells, what to do next. I'm delighted I've got Jeff Probert sitting here today, so perhaps afterwards if there's any other questions you can direct them at him too. But Jeff is our Chief Operating Officer, and he's been with us for about the last 6 months, and I think he's not quite sure where he's been for a lot of that time, but you know, it was great to have Jeff actually down in the field area during the last month during some of these operations. So when we put this package of assets together, and we really did put this package of assets together, we went in to see the company that we farmed into, and we kind of cherry-picked the bits that we wanted. We knew we wanted some high-impact exploration, and I'll come on to that in a moment. But we also wanted to get some existing production that we could build on, and some sort of lower-scale exploration and appraisal activities that we could get our teeth into. You know, it's really important when you're building a business to actually get that operational credibility, and I think what we have done over the course of the last year is to really do what we said on the tin. We set out with a timeline that seemed pretty tough to achieve, but we've actually managed to do all of those pieces of activity that we set out to do. And in doing so, we have added to that existing asset value that sits in the ground. We started off the activities with a series of 3 workovers. Now, workovers can be a little bit boring, I think people might imagine, but actually in a very short period of time we actually added 30 BCF, or around about 30 BCF of gas resources in Fraction D, which we're putting together a development plan for at the moment, and that is a viable low-cost development plan that will be feeding straight into the infrastructure once we get that kicked off. We drilled a total of 4 exploration wells. Now, we need to put these into perspective too in terms of the cost of operating onshore, and in particular in this area. These are really, really quite low-cost operations. I think I calculated that we'd spent something like $1,000 a metre in total over our entire campaign. So there's an awful lot of metres drilled for quite a low cost. That's about a fifth of the average cost of onshore drilling across the continent. And it's about a 20th of offshore drilling. So you know, we've managed to get a good number of metres drilled over the course of this year. All 4 of those saw hydrocarbons. 2 of the wells, one of the wells was depleted in its hydrocarbons and is unlikely to be adding to any production, although my understanding is that we're monitoring that well and actually it's still kind of producing a bit of gas into the wellbore, so that's a positive. One well is a gas well in the north of our fraction D. That again is being monitored, and we've now got a stimulation plan in progress for that. So we'll be heading back to that in the not too distant future. And of course, the well that encountered a significant column of what appears to be oil hydrocarbons is also awaiting stimulation. So these are in quite an unusual reservoir. They're not your traditional 30% sandstone reservoirs. They're in a very unusual volcanic rock. And what we do know is that the norm in this basin is actually to have to stimulate these wells. So we're very excited to be heading towards a stimulation program, as I say, towards the back end of this year. We've also just recently initiated a pilot project to increase production within what was a pretty much shut-in field area. The daily production from that field was probably in the order of less than 20 barrels a day. I'm being told maybe even less than 20 barrels. Now, for a very, very small cost, we've just completed a pilot project. We have recompleted 4 wells. We've added new pumps into the system. We're in the process of tying those, or have tied a couple of them in already, and the rest are just finishing their commissioning. And we're seeing, as we speak, some really significant results. Now, I have seen, and yes, we do read some of the bulletin boards, that you know, people are anticipating 500 to 600 barrels of oil per day out of these 4 combined. That isn't going to be the case, but we are going to see a significant contribution and increase to the production that we have. So I think we need to see all of these things in the context in which they're done. These things cost a couple of $100,000 net to Echo, but they can significantly, particularly at $80 a barrel, add to our revenues. There is no point in us updating you on exact production rates until they've all, what we like to call, oiled in. All of these things take a little bit of time to settle, to get the pumps commissioned properly, and so we will be updating the market on the results of those production figures. But even without those, we are on track to be delivering revenues of probably just in excess of 9.5 million net to us. And as I say, with the peso devaluation leading to those decreases in OPEX, we hope to see some nice results on that by the end of the year. But what about the transformational growth opportunities for Echo within these existing licenses? As I said, when we went into the licenses, we were very focused on some exploration upside. We focused in on a license that had been awarded to our partner just in 2017, last year. And this is a license that has been overlooked. There have been existing evidences of gas in the area from wells that have been drilled there previously, back in the 70s and early 80s, when really they were only looking for oil. We know that there's a well there that we think can produce at relatively high rates, or would have been able to if it hadn't blown out and anecdotally burnt for about 6 months. So, you know, for those areas in particular, the seismic data that we're about to commence shooting is going to be critical to ensure that we drill wells safely. We had a CPR, a Competent Persons Report, commissioned by Gaffney Klein at the time of the transaction, and that identified 41 leads and prospects. And of those, over 3 at least in the mid case had prospective resources of over a TCF. Let's just remind ourselves, what does 1 TCF of gas mean to ECHO? Well, that should have a developed value to ECHO, net to our 50% equity interest, of around about $500 million. So these are significant opportunities for us. We've got 3 independent play types on the block, plus a small oil play that sits out here to the east of the block. So 3 independent oil types, play types. That's important because if you should have failure in one, it doesn't necessarily transfer itself onto another. We're intending to drill a total of 4 exploration wells on those licences over the course of the next 3 years. And importantly, we're heading towards the first of those wells being drilled in the second half of 2019. Before we drill that, we need to shoot seismic, and via a highly competitive bid process, we have just recently awarded a contract, and we are due to commence shooting that seismic in December. And when I say a highly competitive bid process, the savings that we made on that contract award were in the order of about $7 million. And that's $7 million of real cash, and that's real cash that can be put into that exploration campaign. So that was quite an achievement for us to complete. So seismic kicking off in December, 2 cubes. We anticipate that the entirety of that seismic acquisition will take around about 5 months. And clearly we'll be processing each cube individually, so we should be able to start really looking at honing down those locations by the middle of next year to get ourselves drill ready by the latter half of next year. So what can you expect? What's in the pipeline over the next few months? Well, we announced yesterday the Rio Salado signature. I'm just moving away from Argentina here, back to Bolivia. For those of you who know the ECHO story, we have an agreement with Petroleum, who are one of the biggest operators in the area, over one of their exploration blocks, in which there's one of the largest undrilled structures. Around that sits a piece of open acreage that they took an exploration concession on last year with the government. We did a side deal with them. You're only allowed to keep these technical evaluation agreements for 1 year, and you agree a work plan associated with that. We completed the work programme for them on their behalf as part of that. We saw something that we liked at depth. But at the end of that time period, we were not ready to commit to a firm well on that acreage. And one of the reasons for that is that we have 2 wells drilling, one to the east of us, one to the west of us. These wells in general, as some of you will know, almost certainly have a first birthday. That means that they're quite expensive. And really the value in this acreage lies in, real value lies if one of these 2 wells that are drilled actually comes in and is a success. I don't think any of you would thank me for spending $70 or $80 million of your cash on going out there and drilling a well at this stage, but actually we have significant value if we see success in either of those 2 wells. And as part of our work programme this time, what we've managed to do is agree a work programme whereby for a very small amount we acquire some 2D data that goes across that block that was shot by one of the big multinationals just 2-3 years ago for quite a considerably excessive amount compared to what we're paying for it, and we get to incorporate that into our data. So exciting times there. We'll be announcing some of the results on the total oil that is being produced from those pilot pulling jobs over the course of the next couple of weeks. We just announced the EMS 101 pre-stimulation work, and clearly we'll be moving on to bring in the rigless mechanical stimulation units towards the back end of the year, and we'll be addressing both the EMS 101 and the Estancia La Magui 1004. We'll be kicking off the Tapiaiki seismic acquisition in December. And of course that leads through to the fast track processing and completion of the processing. And all of that is aiming towards these high impact drill locations, which should be drill ready by the second half of next year. Of course, if this pilot pulling project works out well, we'll be increasing that. And alongside this, of course, we'll be looking at the Fraction D gas monetisation project. I think it would be fair of me to say that we are still in business build mode. We are in the right postcode here. We're determined that we're in the right postcode here. And not only have we added Jeff to the team this year, but we've also added Martin Hull, our new CFO, who has just joined us after 2 decades at Rothschild's. He's finally jumped ship and come to the other side. And he, of course, brings with him great capabilities in the M&A capacity and has increased our skill set in that area. He's been with us for a couple of months now, and it's really very, very nice to sort of have someone alongside who's able to help drive those parts of the business. So, exciting times ahead, and you know, we look forward to delivering you a significant amount of news flow over the not too distant future. Thank you.
Okay, thank you very much. Pretty comprehensive summary there. Questions for Echo and Fiona? Yes, one over here.
Hello. Could you go back to the slide on Tapi Aki?
Yeah.
You can see you've got a gas pipeline running just to the north of it.
Correct.
Is there spare capacity in it?
Yes, absolutely there is spare capacity. You know, that is one of the joys of this project, is that not only have we got good access to the acreage, and very good pricing when it comes to how much these wells are going to cost. These wells will be slightly more than the ones in Fraction C and D, by the way, but we're still looking at less than $5 million net to Echo's share for any of the wells here. But yes, access to this pipeline, and by the way, this is the Argentinian border just here, and Chile's just across the just across the hills. Then yeah, we've got spare capacity actually in either direction, which is very cost beneficial to us as a company.
And your partner there, are they funded and willing to participate in the wells? They're happy, ready to go?
Absolutely. You know, CGC, our partner, produce about 30,000 BOE a day. So they are very well funded. They're part of a much larger conglomerate. They're the second largest conglomerate in Argentina. Their market cap is something like, well, just the airport side of the business is $1.5 billion listed on the New York Stock Exchange. I think in total the company is probably closer to $3 billion in terms of market capitalisation. So yeah, they are well funded, and yes, this is their key block.
So why do they partner with you?
Oh, now that's not a very fair question, is it? Why did they partner with us? Well, actually, do you know what? I don't think that many people had been out there banging their door that were international oil and gas companies. So a number of smaller service type companies had been talking to them, and in fact, while we were completing the transaction, you know, we were kind of beating off some local companies that had wanted to come in here. Funnily enough, as well, we were talking to another multinational company about something else, and they asked much the same question. They were quite surprised to see our name on the final farm out agreement, and you know, they were just rather surprised, but we formed a very good relationship both at the technical level and at the personal level with our co-venturers, and you know, maybe we just bring a different thought process to the table, but we have built a very good relationship with them, and we see the benefits of that.
One final question. Funding, you've got quite a lot of cash at the bank. Those wells are about 5 million each, you're saying. Are you fully funded for all of next year?
We are fully funded to go all the way through the seismic and to drill a well.
One well. Okay. All right, thank you very much.
Any more questions? Fiona? I was just going to observe here that presumably the sort of negotiations you've been talking about, having come from a background of very large companies, is very helpful, isn't it? Because you have that experience even though you're not necessarily as large.
Well, that's correct. I think at the end of the day, commercial negotiations are the same across the board. Both parties need to win. There is no point having a commercial negotiation where you've got to win. I don't think Donald Trump would agree with you then. He might not, but there again, one would hope that we have a better standing.
Absolutely. Sorry to have compared you with such a person. Any further questions for Fiona? Very polite and giving her some nice questions. Anyway, thank you very much indeed, Fiona, for being one of our companies this evening. Stay with us. We'll hopefully get you all involved in the discussion at the end, but we need to hear now from Malcy, was with us at a previous investor event, was extremely popular then, so we're delighted he's working with us on some more of these events and has brought along the companies that we have with us today. I don't think he'll mind me saying, I'm sure he might even be pleased that if I was to say, I think he doesn't hold shares himself personally in these companies, is that right? So what you hear from him is his view as a long-standing analyst and not as somebody who's trying to persuade you to help him to have a happy retirement. So let us move on to Malcy and see what he has to say.
In fact, the first thing that made me think of was when there was talk about footballers was the transfer market, because on the podium tonight you have three of the most interesting and high-risk transfers that have ever been made. Mr. Knott has gone from GLG to Savannah, high risk but profitable. Our former guest has obviously gone from Chariot to SDX, leave that with you. And Fiona's gone from the Falklands to Argentina. So in itself, it's an interesting move. Thank you very much. I'm very much indebted to London South East for inviting me back here this evening. And it's a real joy, not just to see the place so full, but with so many familiar faces and one or two very old friends in the audience. I even suspect one or two of them may be joining me on the plane to Morocco tomorrow morning, if they haven't made the easy choice to miss this and head straight there. I've been asked to speak briefly about the bucket list, as on so many occasions, but I'm not going to trot through the stocks one by one tonight. I'll be here afterwards if anyone wants to chat about any individual things if they want to, because I don't think you could bear going through it again and again. I'm going to talk about how the bucket list is composed and why, and how one or two companies get onto the bucket list, and obviously we'll take questions afterwards. I'm very lucky that the three guests here tonight are all members of the current bucket list, and I'm able to rest my point about the quality of their companies and thank them very much for their interesting words. I'm also incredibly grateful to them for coming out tonight to share the vision of the companies they run. They more than prove that one of the key tenets of the bucket list inclusion is that management is the most important and first part of the selection process. And it's also something that you in the audience can do something about. The advantage of being able to see, hear and meet with those who run the companies that you, along with thousands of others, own. So since I mentioned the first and most important factor in the selection process, I'll run through a few other points that are important in the process. And there are two things to begin with which are usually completely forgotten by people who read the bucket list. And the first is that the list is by its very nature diverse, and there's a number of companies with different betas in it. And this is for protection, and it is why the list was set up in the first place. Indeed, the inspiration for the list, as a number of people know, was not an oil expert at all, but a leading non-energy related fund manager who saw the oil price crash as purely a commodity issue which would turn around one day, but he just didn't know how to play it. So the first thing is you're meant to treat it like an investment trust, buy all the stocks in it, and then leave it. And I don't think that anyone has ever done that. Although I have been asked once or twice by one or two of the bigger companies to put together a bucket list fund, as it were. And the second thing is that another sticking point about the bucket list, so to speak, is that I am absolutely no good at short-term at timing, at least not deliberately. I make these calls for the longer term, and I'm generally trying to find incredible pops of value. Unfortunately, that means I don't get the timing right. But a lot of people do email me and ask me, you know, if something's happened and when to take money off the table, or if it hasn't happened, am I still happy to be in recommending a stock? And the answer is usually I feel that there's normally significant amount of value to go for. Don't forget, I probably look at sort of 70, 75 stocks, and there are probably 20 that I don't look at that I could do at some time, will do. And by that very nature, if you're trying to pick between 10 and 15 or so stocks, you know, you're going to miss some, and you're going to try and pick the value. For the companies that are here tonight, in the case of Echo, I have appreciated quite early quite what an acreage position that Fiona has established, and it was a significant achievement. And what is more, people ask me why Echo went into the bucket list so early, was that, as she pointed out, they got to grips with the early part of the acreage very, very quickly indeed, and to produce, you know, oil and gas already is a significant achievement. And with tapioca, as it's now called, on the horizon, the significant upside is massively still there. And for Andrew, it was also the case that, you know, I remember sitting in his office several years ago looking at the maps of Niger, because it wasn't an overnight decision. He patiently built that portfolio in Niger, and as we can see now, with 5 from 5 from the initial drilling campaign, you know, that's a success that should not be underestimated. And the Seven Energy deal, and having been a follower of Petrofac for a long time, having seen the mess that Seven Energy was in, the amount of hard work and persistence that has gone in on that deal is about to be rewarded. And as for SDX, with Paul not here, I can say what I like, but it was a good example of merging two companies, one private, one public, and then making an acquisition, and not again. In Circle, the acquisition was it was no gimme. It's the Circle acquisition, and I was on the other side of it at one stage, and you know, it was a very difficult acquisition to complete. On the financial side, I always want the stocks to be well financed, particularly financed enough not to be at the mercy of a partner who might spring an AFE on them at the last minute. But it will be asking too much for a rock-solid balance sheet, because if you look at the way Premier has behaved in the last 2 or 3 years, operationally fantastic. It's been a stellar performer in almost every 6-monthly bucket list, and it's got $2.5 billion of debt on the balance sheet, which most people don't like the look of at all. Some people don't like the fact that some stocks have only got one asset or a primary asset, but that's why it's part of the bucket list. And the question about this is always about something like Jersey Oil and Gas. Last year, Jersey Oil and Gas had put it into the bucket list. It only had Verbier. It was really a one-shot. I knew from my friends at Statoil that they rated it, that they had it in their top 4 potential targets for last year, and I thought the risk was worth the while. I can't say that they didn't give me a shock when the first well came in dry, but I was rather pleased that they did the re-drill, and they're now going ahead to drill with what is now Equinor in December for an appraisal well. Finally, it's worth having a look at how geography plays its part, because initially when I did the bucket list I wanted to find a varied list of places where companies were invested. But actually, when I chose the list of companies, that was all done for me because they all turned out into different parts of the world. Tonight you've seen South America, different parts of Africa, but it might have been the US to the Falklands, or Namibia to Norway, or Kurdistan to Southeast Asia. All these geographies are covered within the bucket list, and not because I wanted to have some exposure in those areas. Finally, on the oil price, and of course the gas price, which is equally important for a lot of companies in the bucket list. And these play what can only be described as an infuriating part in the energy sector. The oil price in the bucket list, as Rudyard Kipling might have said, east is east and west is west, and never the twain shall meet. And it really infuriates a lot of people who write to me, who say that it would be funny if it wasn't true, but it proves the point that the oil price can go up sharply, and oil company shares do not follow them. In fact, they significantly lag. And in terms of how that works this year, for example, I mean, I look at the buckets every 6 months and just give people an idea of how the stocks have performed, and they always like to see the sort of rolling league. But in February, when it came out, West Tex was a 63.01, Brent was 66.63, and natural gas was 269. So yesterday, if you'd said that West Texas at 71.34, Brent at 80 spot 43, and natural gas at 316, having been 330, and it is again today, most people would have taken your arms off for that at the beginning of the year. And now we're getting is grumbling. It is a lag effect. It always has been. It stems from what can sometimes be a great deal of incompetence from the professional investment managers who have a fear factor and a sheep factor as well, where they follow each other out of the sector in order to try and avoid any risk in the process. And also, it's a fact that quite a lot of the stocks that are in the AIM market and the smaller and mid-cap players are owned by either retail shareholders, and I think that having spent nearly 40 years in the industry, most of that in as specialist sales or advising companies, I find that, and I'm not just saying that because I'm here, it's just that there are most of the people who are really good retail investors would knock into a cocked hat some of the people who can consider themselves professionals in the energy play. Just briefly to finish, I would say that for those companies that that have only production should follow the oil price, and the ones who don't have exploration or who aren't quite so mixed, it doesn't work like that either. Since February, out of the 18 stocks in the bucket list, 18 are up and 7 are down, and there is nothing. I tried all day yesterday to try and find something that links them all together, and it doesn't happen. The up stocks since February have averaged 38.6% up, and the down ones have averaged minus 23.5%. If I get one more question about what's happened to Aminex or Amerisur or anything like that, I'll go through it if I can, but in some cases there's no rhyme or reason why these stocks behave the way they do. If anyone can tell you that, it would probably be Andrew, because he spent such a long time on the other side of the investing fence. But with its 5 discoveries in Niger and sorting out the oil sales plus an amazing deal in Nigeria, the market has been particularly slow to appreciate quite how much upside there is in Savannah. And even now, I don't think it's in the price. So I'm fortunate to be here tonight with 3 of the best companies in the sector and 3 of the best companies in the bucket list. As I said right at the beginning, it's significantly down to management quality and where they are and how they run their businesses. But I have to say, like I've said all the way through this, since 2015 when we started the bucket list, that it is quite a lot of complete guesswork. I'm not going to try and say anything else, but I will take questions as asked.
I was just, while you were finishing there, I just noticed that Malcy advised the government in the sale of British gas. I was just wondering if he's going to have to advise Jeremy Corbyn if he wants to buy it back. We'll save that for another day. Okay, so any final thoughts, particularly about investing in companies, both those we see here? I don't know whether these guys want to come back on any of that we've heard from Malcy. Any final thoughts or questions from the floor? Okay, so just before we finish, any thoughts about what sort of this overview Malcy's had about the players like yourself? Andrew, Fiona. Okay, well there we are, short and sweet. Obviously everybody's keen to enjoy the refreshments. Anyway, thanks very much, Malcy. But